Hi, welcome everybody. I'm going to walk you through a quick example here that's going to look at break-even EBIT and analyzing some use of leverage for a firm, and really comparing two different capital structures that a firm may pursue. So here's a question. This is from Chapter 16 for those of you guys in my class. Colby Corpus compared two different capital structures. Plan 1 result in 3,500 shares of stock and $37,440 in debt. Plan 2 result in 2,800 shares of stock and $66,560 in debt. So we're going to use an interest rate of 10% on that debt in both scenarios. So let's jump right into it. Here's some summaries of what we had in the question. Plan 1, 3,500 in shares outstanding, 37,440 in debt. Shares outstanding. Plan 2, there's the 2,800 and 66,560 in debt outstanding. Other givens that we have, we just extracted 10% from the question. We're going to see once we get into A, we're going to assume an EBIT across all three scenarios of 14,800. In a case of just all equity, no debt at all for the company, we'll have 4,400 shares outstanding, and the tax rate we're going to use is 21%. So let's jump right into question A. It says, ignoring taxes, compare both plans to an all equity plan, assuming EBIT of 14,800. The all equity plan would result in 44. So we have that information extracted all there. So no taxes, we don't have to worry about the tax rate here, but we do have to calculate the interest on this. So to get the net income, and then we'll get eventually to our interest rate multiplied by our debt outstanding in plan number 1. So interest in that would account for about 3,744. In number 2 here, we have, again, in our interest rate is going to be 10% multiplied by our debt outstanding here. We have much more, 66.5. So that's going to result in a much higher interest payment. And in our third component here, we obviously have 0. We have no debt. We have no interest to pay on that. So our net income here, we could just simply equal EBIT minus our interest. Remember, we don't have any taxes in this scenario here. So our net income for plan A across through our equity component here, just delete these guys in the middle. You can see that our net income across the three scenarios here varies a little bit depending upon the capital structure. Now, if we go to our earnings per share, we just take our $11,056 here in net income in plan A, and we divide that by our numbers of shares outstanding. This is going to give us an earnings per share of 316. Okay, same thing here. We're going to have our net income of 8,144. This is going to be divided by the number of shares outstanding in plan number 2. Okay, so we have a marginally lower earnings per share in plan number 2. And in the all equity plan, we're simply going to take our 14,800 divided by our 4,400 here, the numbers of shares outstanding. We have $3.36 in earnings per share. So when we look at this, we can see that from this, our highest EPS is a firm of an all equity component. And we can compare this against the 316 and 291 in plan number 2 and 1 respectively. Now, we go down here for part B. It says in part A, what are the break-even levels of EBIT for each plan as compared to the all equity plan? So if we look at this, we can walk through this example in calculating, hey, what's versus the all equity plan for plan 1 and plan 2, what is the break-even levels of EBIT for these guys? So to do this, we'd go through for plan number 1, we could just press equals, and you can follow this equation with me as I go through. We would say in our first component here, we'd open a bracket and we would say, well, we're going to start with the numbers of stock outstanding for an all equity firm. So we're going to take 4,400, and then we're going to multiply this by the interest rate, 10%, multiplied by the level of debt we would have in plan number 1. So multiplied by 37,440. Close that parenthesis there, and then we're going to divide that by a denominator which would be equal to 4,400 minus the the numbers of shares outstanding if we went with plan number one. Okay, so that's the first break-even level for plan number one versus the all-equity plan. So we hit enter there. We're going to see that comes out to be 18,304. We'll make this into a numeric for you. For EBIT, remember we're break-even levels for EBIT here. So then in the second one, plan number two, okay, this is going to equal kind of the same scenario here. We're going to start with the 4,400. And we're going to multiply this by the interest rate multiplied by the debt outstanding now for plan number two. Okay, so now we go over to plan number two, we multiply that. Okay, so we have that, and we're going to divide this by, you guessed it. Okay, so we're going to divide by, okay, what's the stock outstanding in the all equity minus now the stock that we would have outstanding in plan number two. Okay, that's going to go in the denominator there. We have that within, we hit enter, and voila. What do you notice? Both of these numbers are exactly the same. Break-evens for plan number one versus the all equity, and break-even plan for number two is all equity. Now, why is this the case? Well, this goes back to proposition one of Mugliani and Miller. Okay, doesn't matter. Okay, how you finance your firms, it's irrelevant in this respect here. So that is the break even here. I'm going to just populate the equation here for you guys to see. Okay, so if I just formula text here like that, I can just pop it in there, and you guys can now see this and what the formula was used for these guys here. So this is what we would do to calculate with the break-even levels for plan one versus all equity and plan two versus all equity for this scenario here. If we go down, I'm going to skip the version question C here. This is ignoring taxes. When will EPS be identical for plans one and two? It's going to be similar to what we just did here. No worries to do that. We'll get down to the part D here now, and part D asks, okay, repeat parts A, B, and C, assuming that the corporate tax rate is 21%. Are the break-even levels of EBIT different from before? So we're going to kind of just go and calculate EPS. We're not going to worry about going back to this break-even component and comparing this. But how would we do this and compare earnings per share for plan 1, 2, and the all-equity firm? Simply, we would just go through, well, we have to calculate what our interest is again. Well, hey, we already have interest here, right? So we can just copy and paste. This is not going to change. We can just copy and paste this down here, and I'm just going to paste these values down here. So we already have that component already. Number two is going to see, well, what's the taxes, right, that are going to be required to be paid in all these different scenarios here. So simply here, we could take, in this case here, we could take our EBIT, okay, minus the interest that we had paid here, okay. So this is going to give us our earnings before taxes, okay, and then we can multiply this by what the tax rate is. And here the tax rate is 21%. And when I put this 21% in here, I'm just going to press F4 to keep this constant so that we can drag it across and calculate what the taxes are going to be due for the other three columns here, plan two and the all equity component. So if I hit there, it tells me that under plan number one, I'm going to pay approximately $2,321.76 in taxes. If I drag this across now, okay, let me just get rid of these two guys here. Okay, just clean it up a little bit. You can see that I pay less taxes in plan number two, right? So again, this is the same component here. This is just taking your EBIT minus your interest multiplied by that 21% tax rate. Obviously, we pay much less tax here. Why? Because we have a much higher interest deduction here. Remember that interest payment is really a tax shield, right, in this scenario. And in the all equity, well, guess what? We don't have any interest. We knew that, but with that said, we're not using any interest to shield some of our income from taxes. So here you can see that our taxes in this case, we're going to have a much higher tax component in the all equity finance firm. So net income here, okay, So we have our earnings before interest and taxes. So all we have to do, we take that EBIT minus our interest payment minus our taxes, and this is going to give us our net income in all three scenarios. I can just drag this across here, just clean this up a little bit. Okay, so I clean that up. Again, we have net income, the highest over here in the all equity component, mostly because we did not have any financing component related to that from debt. Okay, and so now to get to our earnings per share in this scenario, all we do is take our net income and we're going to divide this by numbers of shares we'd have in plan number one, so that's 3,500. We had enter earnings per share in this case scenario is 250. Okay, same thing we do for plan number two, net income $6,433.76 divided by, well, hey, we go up and say we had 2,800 shares outstanding in this case, so our earnings per share in plan number two with taxes associated is $2.30. And then our last component here, we take our net income divided by numbers of shares outstanding in the all equity component. Okay, we hit enter and we can see we have $2.66 in earnings per share. Now, what do you notice here? Obviously that the earnings per share, okay, in this component, this is much lower. All three components here, right, are much lower than what the earnings per share were in the first case, and that's obvious because we have taxes associated within there. So that's a quick rundown here of calculating some components and comparing between an all equity versus other components of a capital structure and different terms of differences between them. We'll go through a couple different other scenarios and other questions as we go through the capital structure chapter, but that should give you kind of an idea of how things can change with using kind of different capital structures to finance the firm. If you have any questions or comments, please leave them below. Thank you very much.